Well, we've seen a major revelation from the Federal Reserve this week, namely that they are signaling interest rates, short-term interest rates, will begin to go up only a few months after the end of the QE program. We saw the Fed cut quantitative easing by another $10 billion to a total of $55 billion at this week's meeting, and that's likely to dwindle down to zero by this fall. And then Chairman Janet Yellen signaled that after that, perhaps as soon as 6 months after that, we could actually see the next hike in short-term interest rates, something I've been warning about for a long time, but now the Fed is officially acknowledging. Well, we've seen short-term interest rates shoot up on this Fed news. We've also seen 5-year and 10-year Treasury yields move higher and 30-year yields move higher to a lesser degree. Essentially, again, what the Fed is acknowledging is that the economy is stronger, that there's no need for this crisis-era interest rate policy anymore, and that's going to unleash the lid on this pressure cooker in terms of interest rates. We had the first phase of the sharp move higher in interest rates last summer when Ben Bernanke first suggested that tapering of QE was going to happen. Now I believe we're in the second leg of that move, where not just long-term interest rates, but short-term interest rates rise as the Fed looks to normalize the interest rate environment overall. I think you're going to have both major winners and major losers from this environment. I think the winners are going to be investments that rise in value as interest rates rise. This would be things like leveraged inverse bond ETFs. I believe we're also going to see some of the financial stocks that are actually poised to benefit from rising interest rates continue to surge. That would include discount brokers and some of the larger money center banks. Again, I think what the Fed is acknowledging is that it no longer has the need to artificially suppress interest rates across the yield curve, which as they release that artificial pressure lower on interest rates, we'll see bank margins, profit margins expand, and we'll see lending overall get more profitable. So I think that's good news for some of the banks that aren't overexposed to interest rate derivatives. For Money and Markets, this is Mike Larson.